When traders come to markets, they do so because of the possibility of making money, of profitability. And they acknowledge implicitly by engaging in markets that this potential for profitability is a function of the uncertainty that markets bring. New investors/traders, and I use the term interchangeably as always, tend to fall into two camps. And I will give them a sharp delineation, which is probably a little bit unfair because there are people in the middle. The most popular category is undoubtedly those who adopt a fundamental approach. That is, they scour company reports, financial statements, and the like, looking for some kernel of knowledge that points them towards the future, that in some way they believe they might discover something hidden within the company report that will give them some idea as to what the future of the company will be. The problem with this is that all you are doing is by and large building a story that confirms your initial belief structure. So you've fallen into the notion of a narrative fallacy. Now you do get to vote, and your vote is you may either buy or sell a share or a given instrument. The problem with that is your vote doesn't count. The only vote that counts is the market's vote. So irrespective of what your perception or story of a company might be, there is no way to convey this story to the market, nor is there any way to convince the market of your story. It just remains a story. Traders who look at technical analysis fall into a somewhat similar psychological hole, in that they believe that by plastering the chart with indicators and tools, that you in some way generate a predictive mechanism, a mechanism that tells you what tomorrow will bring. The thing they tend to ignore is that all indicators are merely iterations of price. So as such, they are always lagging. They are always looking back. They're very good at telling you what happened. And traders, by and large, who use this methodology forget that our original money management, our original position sizing, was called bet sizing, and that more adequately reflected the uncertainty that our methodologies used. I understand why people do this. There is an attempt to draw back the veil of what tomorrow's prices will be, to somehow to remove the opacity of the future. And it falls into that very, very human frailty of believing that the more information you have, the more control you have. Unfortunately, that's not true in markets. You have no control. Just as our fundamental investor got a vote that didn't count, technical traders are merely passengers. And as a passenger, you have no say over where the instrument you are participating in goes. And the unfortunate thing that traders have is that they ignore the amount of information you can get from price and price alone. And that's what I want to talk about. I want to talk about this notion of very, very simply doing a version of what used to be known as reading the tape. That is, understanding what the price action is telling you in its very unadulterated form. And the vehicle I want to use is Tesla, which is somewhat topical at present with the tangential goings-on with Twitter. When you present a chart of Tesla, and this one is a weekly chart dating back to 2015, you see a somewhat familiar pattern, and parts of this pattern appear in all instruments over all timeframes. You have this base, you have a climb, you have consolidation, you have fall. And traditionally, these are delineated as stage 1, stage 2, stage 3, stage 4. The change of state between each stage is somewhat messy and is often never perfectly defined or delineated. And those who are familiar with somewhat of the history of technical analysis and who've done their reading and who have an extensive library will recognise this. This is an approach that was popularised by Stan Weinstein, and he talks of this notion of stage 1, 2, 3 and 4, and that this being applicable to all instruments, all time frames, all markets. And that is true and correct, because at some stage in price action, you will see these stages unfold. But this brings forth perhaps the most important lesson that a trader/investor can ever learn, and that is that the only time to ever buy anything is when it's in stage 2. Unfortunately, the majority of people do not learn that. They're either not exposed to it, their psychology is opposed to it, because there is a belief structure based around the notion that you should buy things as they get cheaper, that somehow buying things as they get more expensive is illogical. But that's precisely what you should be doing. And so what I've done here is I've applied Weinstein's 30-week moving average to Tesla on the weekly chart. And you can see there are clearly defined times to own the stock. There are clearly defined times to be involved and times not to be involved. And if there is a lesson you take from anything, it is the notion that there is a time to own a stock and a time not to own a stock. What I've done in this next chart is I brought the time scale down to daily. And this is Tesla year to date. And I've done so because it presents us with some very interesting and very simple lessons. The first of which is that when I look at this, the first thing I want to highlight is this notion of congestion. This is a micro pattern of almost stage 1 repeating itself within a much broader stage. And you see that. You see this notion of this sort of fractal expression of patterns over time frames. And those who have followed along with the blog will have noticed that I've been speaking about this recently with relation to Bitcoin. And I made the observation that whenever I point out consolidation of this sort, the people automatically make the assumption that price will break to the upside. For some reason, there is a belief structure within traders that the law of gravity has been repealed for prices and the prices never break down out of consolidation. That's not true. But what this also highlights is one of my favourite tools, and that is a simple straight line. Doesn't involve any calculation, doesn't involve a complex program, doesn't involve you attempting to predict the market in any way, shape or form. You just draw a very fat straight line across the top and bottom and prices, and then you go away. And that's the hard part. You have to go away because there's nothing to be done in consolidation. What people tend to do, though, is to draw these lines and then say to themselves, well, I'll just buy it at the bottom and sell at the top. What generally happens is they end up buying and selling at the midpoint and churning their account. But you remember when I spoke about Bitcoin, I looked at the notion of volatility. And here I've used average true range as a substitute for historical volatility. And you can see the same volatility compression. The volatility of price compresses until you get the breakout. And the joy about this breakout is that it is so definitive, and it is definitive in the form of a gap. And it's definitive in the form of a gap with a strong lift in volume. This is one of my favourite patterns, and it will always remain one of my favourite patterns purely and simply because of the simplicity. The long-term trend in Tesla is down. We've had consolidation during that long-term move down, and now we've accelerated and broken further to the downside under volume. What is intriguing about this is that people will see this pattern occur and instantly go, that's bullish. And it might seem that that's a stupid statement to make, but look at the volume. We can make the simple assumption that for every buyer there is a seller. It's not quite true, but it suits our purposes for this. These sellers have to be selling to someone. Someone has looked at this and gone, that is a bullish formation. That works for me. Now, the motivations for that are up to the individual. It could be someone engaging in the idiotic practice of averaging down. It could be someone who takes a completely different view of what is occurring to the company, to the people who've seen this pattern and gone short. Whatever their motivation, this is clearly not a bullish development. But what is interesting is that if we look at this chart early on, around about April in the first quarter, there is another gap down. But this gap in the short term fails. So the question is, why does it fail? And the answer to some degree can be found in the volume. Gaps and volumes go hand in hand. A gap under a strong lift in volume is very positive. Gap by itself under modest volume, whilst interesting, is not that convincing. You'll see here that the gap is actually filled in the next few sessions, but that fill is rejected. And we can see that here. This small lift up is rejected, and price again begins to fall under much heavier volume. And you can see that there is a substantial drop-off in volume during that uplift. Price meanders up, it doesn't power up. So we have this notion of price and volume working together. And the sentinel event is this candle here, which breaks down and does so under high volume. So every time you see something occur, the market is actually telling you something simply by its actions alone. There's no need to plaster the chart with all sorts of bits and pieces for the majority of your trading. Yes, we do need mechanical scans to shift through all the data that we're given. Because if you're an equities trader, there are simply too many instruments to go through by hand. It's too laborious and too hard. You have to have a series of gates that price gets through before it gets your attention. But once it's got your attention, it is these simple things that become the most effective. So we are left with a chart that looks like this as our endpoint. But we still face a problem. And the problem is that these things that I have pointed out are only obvious in hindsight when I'm sitting here at the last candle looking backwards. When we make our decisions in trading, we are limited. We're limited by the quality of information we receive, the time we have to make the decision, and our cognitive ability. None of those three will ever be infinite. And the unfortunate thing in trading is that despite being able to see these patterns in real time and act upon them, we're still acting in uncertainty. Because by the time we have perfect information, the opportunity has passed. This is the point in time in which we have perfect information. But we can't act upon the past. The time for action on these events has long gone. So now we're back to this notion of dealing with the uncertainty that markets bring to us. But trading in and of itself is about being comfortable with this imperfection and the discomfort that brings. And it is often said, and I do tend to agree with it, that if you are comfortable trading, then you are doing it incorrectly.